Hello everyone, and welcome to another productive video. In today's video, I will teach you a scalping strategy based on price action analysis. No indicators are used, just a price chart. Watch till the end, and let's do this. This scalping strategy is popular among traders and has been used for many years. As mentioned, we don't use any indicators, relying solely on a naked chart. We employ two time frames, the 15-minute chart for identifying general market movement and levels, and the 5-minute chart for trade entries. We begin with the 15-minute time frame. Once a candle closes, we mark two lines at the high and low of the candle. For this, we use a tool for drawing lines. After marking these levels, we switch to the 5-minute time frame to find a potential trade entry. Here's how we trade using this strategy. 1. Start on the 15-minute time frame. When a candle closes, for example, let's start from here, draw lines at the high and low points of the candle. As you can see here, for example, if a candle closes at 10 a.m. EAT, we mark the high and low of that candle. After drawing the line. 2. Switch to the 5-minute time frame. Please pay attention. When drawing this on live market, you pay attention on the candlestick that formed and close before the live one which is forming. Draw the low level and the high level of the candlestick. Now back to demonstration at 10 a.m. EAT, the 15-minute candle started. Now, switch to the 5-minute chart time frame. Note that one candle on 15-minute time frame is equal to 3 candles on 5-minute time frames which started at 10 a.m. This corresponds to 3 candles. We look at the next, 4th, candle. If this 4th candle closes above the high line, we enter a long position as the new candle opens. If it closes below the low line, we consider a short position. Now, how do you set stop loss and take profit? The stop loss depends on the distance between the high and low lines. If the distance is short, set the stop loss below the low line. If it's a wide distance, set the stop loss somewhere in the middle. Example, in this case, set it here below the low of the middle candle and the profit target is set at a level that gives a risk-to-reward ratio of 1.5. Let's have practical example. Let's go through an example. 1. Marking levels on the 15-minute chart. Consider a candle that closes at 11:15 a.m. EAT. We draw lines at its high and low of the candle like this then. 2. Switching to the 5-minute chart. Let's see if price broke the resistance level and at 11:15 a.m. EAT, we look at the next 3 5-minute candles which are here 1, 2, 3 and if the 4th 5-minute candle breaks and closes above the high line, we enter a long position here as the new candle opens. Set the stop loss below the low of the 3rd candle. Set the take profit at a 1.5 risk-to-reward ratio. Now let me show you a way of handling a doji and spinning top candles. Avoid trading when a doji or spinning top forms, as these candles indicate market indecision and higher risk. For example, let's watch this closely. If a doji forms at 10:45 a.m. Switch to 5 minutes time frame and here it is. Candle started here 1, 2, 3 and the 4th candle closed above the high, so enter a long position, but if you pay attention on price movement here, you can see the strategy might give a signal, but the risk is higher due to flat price movement. So when a doji or a spinning top candle forms, avoid taking any trades because that is so risky. Let's cover this topic before I end this video. Trading on price declines. For declining prices, the process is similar, but we focus on breaking the support level. This is the process. 1. Marking levels on the 15-minute chart. when a candle closes, draw lines at its high and low. After that, 2. Switch to the 5-minute chart. Look at the next 3 5-minute candles. If the fourth candle breaks and closes below the low line, enter a short position. Set the stop loss above the high of the third candle. Set the take profit at a 1.5 risk to reward ratio. Let's go to 15 minutes time frame. Here we got a green candlestick and it's actually a pullback showing a declining of a price. Let's mark its high and lows and see how the market plays out after that. Switch to 5 minutes time frame. We can see it here 1 2 3, and as you can see, it didn't give us a signal to open a long position. Let's go back to 15 minutes time frame. Important points. The fourth 5-minute candle won't always break the high or low levels. In such cases, no trade is entered. Example, let's say we want to watch this candlestick, marking its low and high. Switch to 5 minutes time frame. They are here 1 2 3, and here you can see the fourth candle didn't break this low. So we don't enter any trade here. What does that tell you? This strategy is effective during clear market advances or declines, but less reliable during flat market conditions. It's best to avoid trading when the market is flat. Make sure when taking trades, all the rules are met, because it's not a guarantee that you will get all the signals correct. The most important thing is looking at where the fourth candlesticks will break and close to. Remember, to make this strategy work effectively, you must apply risk management. Effective risk management is crucial for success with this scalping strategy. Understand that losing trades are part of trading, and it's impossible to win every trade. Implement a risk management strategy, such as the 1% rule, to limit losses. That's it for this video. Thank you for watching. Remember to test this first before trading with your real money. And if you haven't subscribed yet, please do so and hit the bell icon. See you in the next video.